Hey everybody, Brian Shannon here from alphatrends.net. It's Thursday, the 2nd of April, 2015. Hope you had a good week in the market. The S&P 500 gained marginally, the NASDAQ down slightly. Russell 2000 continues to be the leader here, up 1.25% this week, and now up 420 for the year for 0.2% that is. And semiconductors lost some ground, so really mixed market. We had oil bounce a little bit. Let's make some sense of it by looking at the charts here, or see if we can make some sense of it, because it is kind of mixed messages right now. If we take a look at the S&P 500 with no moving averages, you would see we could draw in a trend line here and see that we're having a little bit of trouble with that trend line off of the October lows. But what you also might notice here is we have a lower high. We have this low, so we had this high, we had a pull back to this low, we rallied up to a lower high and then pulled back and made a lower low, and then we rallied up once again, and that high is lower than the previous high. So we have this pattern here where it seems as though the energy is being absorbed to the downside, and that meaning that what we're seeing is that the sellers are getting more aggressive price wise. We had, of course, that gap up that continued to rally higher. Hopefully you'd seen the chart that I had posted on Twitter and in social media about that, about gaps higher and how they continue to rally often, and that's just meant for that day. But basically we were looking for the possibility that the 5-day moving average could hold as support and the market would start to turn back up. That was the positive scenario we were looking for, but again, with an open mind and with a positive dose of skepticism, or a healthy dose of skepticism with a declining 5-day moving average, you don't buy into that. Instead, what we're seeing here is we do have the lower highs, and we had one again here today, and the more times that this support is tested, the more likely it is to fail. So it's not a prediction here, but it seems as though the energy is building to the downside, and if we break through this band of support, then I think that you have to really take that seriously and consider that we could be in for a deeper correction. Where we are right now, also on the year-to-date chart, you can see that volume-weighted average price year-to-date continues to be a fulcrum point here, as well as this being approximately the 50% retracement of the range for the year. So if we break this range, I think a test of the 61.8% down near 203.40 would make sense. Right now, I think you just have to go real slow and wait till the market gives us some indication of whether we've got the 5-day moving average flattening out right now, but what we don't have is a pattern of higher highs and higher lows above it. Breaching today's high on Monday would then be a higher high, and you could look to get long with a stop underneath this level here. But again, going back to the daily chart, we've still got mixed messages. We've got a declining 10 and 20-day moving average. So with mixed messages, there's nothing wrong with taking the trade when it makes that higher high, but have lowered expectations and adjust for those lowered expectations with smaller share size and perhaps tighter stop than what you might normally have. You have to let the market give us the actual evidence. In order for this market to really, I think, be considered turned back up again, we would need to see this little band of resistance, basically 208.25 to 208.60. If we could get back above that and hold above it, then I think that this market would be in a better position to be able to continue to move higher. But again, we've got what's maybe looking like a descending triangle setting up in here. It's just very uncertain, and here we are about to enter the first quarter earnings season, and that will play a huge factor in the stocks the stocks movement. So do be aware of when the companies that you trade are due to report earnings. Most of the time, it's simply not worth it to hold in front of earnings unless maybe you're a longer term investor. But for a trader, really no point of taking that extra risk. The NASDAQ has fallen short at its declining 10 and 20-day moving average this week, and going back again to a chart with no moving averages at all, we can see a lower high, and we can see this lower low. We bounced up and made another lower high. So this is going to be the key level near about 107 for this market to get back above and hold above on a closing basis, basically 106.65 to 106.90. If we can get back above there and hold above there, then I think the intermediate term we could have a little bit more faith in it that it would have the ability to make some bigger upside. But we have the same type of pattern here, which is is we've got this band of support in here, and we have the lower highs coming down into it, and that weakens the resolve of the buyers. It doesn't mean it can't go higher, but it means be very careful. The year-to-date volume-weighted average price for the NASDAQ was tested almost to the penny this week, which shows again why we look at things like this, and twice in there. So this is turning into be an important level right now at about 104.30. It's not the magic level that you just short below. You have to ask yourself, how does it get to that level? So if it breaks down, then this would be our most significant, most recent and relevant lower high to place a stop just above if you are to get short on a breakdown. So keep that in mind for next week as well. The Russell 2000, again, this remains the strongest market. It's obviously, you look at a weekly chart, there's nothing bearish about this. We broke out these highs and continue to hold above that 120-ish level that's been important, and we have the higher high, a pattern of higher highs, and we can even just look at it here, but we still have the pattern of the higher highs and the higher low. This is just on the next move, we'll see if it can continue to move higher, but for now, we still give the benefit of the doubt to the buyers in the Russell 2000, in particular because, we had seen that gap higher on Tuesday, it pulled back, the 5-day moving average flattened out, and then it made the higher high above that flat to rising 5-day moving average. So for next week, if we get back below 123 on the Russell 2000, that would definitely be a reason to look at this market with the Russell with a lot more caution. But for now, it's still innocent till proven guilty. Semiconductors remain very volatile, and here we can do the same exercise just to unclutter it and see that we have lower highs and we have lower lows, and this market may continue to recover and get back above about that 56 and a quarter level. But that's the key area right here at this point. And if you look at where we were a week ago, so this was 5 days ago. Let's take a look in here. 5 days ago, we had this market up on big volume last Friday at the end of the day, and that came, again with that big volume. But here's the volume-weighted average price since then. We're still having trouble with it. So the average participant since that gap higher is not doing well. They're not really getting hurt badly either, but we do have a higher high. This thing is we don't chase a gap. Instead, now if we can breach 55.50 on Monday, then perhaps with a tight stop just under here, we could see this market continue to rally a bit. But again, with that daily chart, lower expectations. We're going to have to get back above and hold above 56 to 56 and a quarter for us to think that this market can really sustain a turn. So if you're going to buy it above here, be very aware that this level is likely 56 to be where we find resistance. So is the risk worth the reward? That's something you personally have to determine. For me, it doesn't seem like a great trade, but there's no guaranteeing that this would become resistance. The market may trigger beyond 55.5 and then just blast right through there and continue to move higher. We simply don't have a crystal ball, but with a declining 10 and 20-day moving average and a volume pattern of increased volume on the downside, then we want to be aware that there's certainly the possibility that this market will fail to hold up, and breaking below 54.5 would be the key level to look at. That if that's broken and holds as resistance, I think it's very likely that you could see a test back down towards these recent lows. So again, a lot of mixed messages in the financials. Really not seeing a whole lot of reason to do anything in here. This has been just a sloppy market. It's also below the declining 10 and 20-day moving average. It is recovering above that 5 days, so maybe back above this high. It's good for a little bit of a trade, but we've been in this messy range all year, so to me it just doesn't seem worth trading the Russell the financials. But back below 23.80, that might be the catalyst for a little bit deeper pullback. Let's take a look at oil for a moment. Oil is, as I've mentioned on Twitter, it's the best case scenario is that it's in the bottoming process. We correctly identified that this market would fail with the declining 50-day moving average, and it came down and made new lows. The market then rallied rallied pretty strong here over the last 2 weeks and then pulled back, and we've got that 50-day moving average flattening out. That doesn't mean it's all systems clear, because of course you're going to see, if you had a bigger picture chart, you're going to have a declining 100, 150, 200-day moving average. So right now, if you're looking for a trade in oil, I think the best you're going to see on the upside is this prior band of support right in here, which turned into resistance. And then if we, and this would be our higher low to protect ourselves with a stop under. So taking a look at this action basically from about right here, if we take a look at it basically from this point forward using 240-minute candles, so each candle represents 4 hours, here's that low that we saw this week where I said, if we're looking for a rally back up towards 54, this is our worst case stop under here. This is the higher low. What you can also see is this being a shoulder, a left shoulder, this being the head, and this being a right shoulder, and this is the neckline. Now the neckline doesn't mean you buy directly above, 1 penny above a break of the trend line. Trend lines tend to be a band of resistance, but it's worth noting that we have this pattern here, and for continued bounce within a primary downtrend, we might see oil continue up towards 54, 55, but that doesn't change the longer term downtrend, so just be aware of that. Shares of Apple, still kind of in no man's land here, just kind of coiling up with this downtrend line, this uptrend line. Here's the volume weighted average price year to date. We've got this stock that is trying to hold back above a rising 5-day moving average, so what we would need now for a buy would be a higher high above that flat to rising 5-day moving average. So on Monday, does that mean I would buy it if it was to gap up above here? Absolutely not. It depends on, and this is something I talk about all the time in Alpha Trends for subscribers, it's how it gets to that entry as well. You don't want to chase. You want to be in a position where you're able to have a low risk stop. So let's say, for instance, that this is where we closed right here, so I can draw. Maybe it gets up towards that level, pulls back, and then breaks out. This would be a good place to purchase with a stop under here, because this would make a most recent relevant higher low to place our stop under, that if we make a higher high above a flat to rising 5-day moving average, our stop will go below here. So the daily time frame, it's struggling to hold this 50-day moving average. My preference, and say what you want, but my preference is that it actually breaks down. I would prefer to see Apple break down and come in towards this volume weighted average price year to date. I think a lot of people get trained to buy on the 50-day moving average, and unless the evidence is actually there on multiple time frames, it doesn't make sense to be early. So anyways, I'm not wishing for anyone to lose money. That's just simply something that will make the stock stronger if it breaks down and then comes back up. So some other names to that we look at, the bonds continue to show more signs of stability here, holding this 50-day moving average and this prior resistance. So the bond market has had a great rally. They pulled back deeply and are recovering. Seems like they probably are, at least for now, this is the little range, 130 to 132. 130 to 133. Break beyond that, it should continue higher. Break below it, I think would get people nervous. So just be aware that the primary trend is still higher, but and here we're seeing a little bit more on the intermediate term that we're just a little bit more neutral in here. So I don't see any reason to make a bold call by any means on that. When you look at stocks like the Wall Street marketing machine has made people obsessed with this Alibaba. It trades 16 million shares a day on average over the last 20 days, and it's still in a downtrend. We've got a declining 20, we've got a declining 50-day moving average. If you take a look at the volume weighted average price since this stock came public, you can see the average price paid for this stock since coming public is $98.23. There's not a lot of people making money in this stock. The only people who are really making money are the venture capitalists and the insiders. The stock is in a downtrend. It is, I say it and people think it's funny, but I'm trying to make a point when I say it's a piece of garbage. The stock is a piece of garbage. It's in a downtrend. It's destroyed a ton of shareholder value by again, the volume weighted average price since the stock came public way up here at 98 bucks a share. The average participant right now is down $16. It doesn't mean everyone's losing money, but when it goes to, again, recognizing the Wall Street marketing machine machine and telling you that this is the great company, that you have to own it, that you can just close your eyes and buy it, it's complete horseshit. Don't listen to that. It's in a downtrend. At best, it's starting to neutralize here, but there is no evidence that this stock is moving higher. Same goes true for GoPro. People got excited. Somebody asked me about it in Alpha Trends the other day right here. I said, listen, it's right up against a declining 50-day moving average. When the 50-day moving average is declining, the stock is considered guilty till proven innocent. That's all I have for today. Thanks for tuning in. By the way, on Sunday, not only is it Easter, but it's the 9th year anniversary of Alpha Trends. Thanks for valuing my opinion and my work all these years. Have a good long weekend, and I'll talk to you next week.